Greetings, comrades. It's late November. I'm about halfway through a brief stretch of Head Start with my Unit 3-4 classes. I've got 5 accounting rookies. They haven't done Unit 1-2. And we're about to start recording entries in the General Journal, posting these entries to the General Ledger, debits and credits. A good preamble to this is completing some analysis charts because it reinforces the notion of the twofold effect of accounting transactions. And that's where we're going with this clip. First of all, I'm just going to acknowledge my source. I pulled this exercise from the Macmillan textbook. Okay, so let's look at this first one here. We've paid some rent and there's a GST component. So we need to create a rent account. And in terms of the classification of rent, because it involves a consumption of an asset in the form of cash at bank, we need to classify it as an expense, because when we get to the end of the rental period, we're going to have to cough up another month's rent or whatever the period is. So rent is an expense. It's going up because what we're doing is we're keeping tabs on the amount of rent consumed or incurred over a reporting period. So it's an increase. And according to our rules of double entry, when an expense increases, we do a debit entry. Okay, it actually reduces our profit. Profit increases the owner's residual claims on the assets in owner's equity. Expenses do the opposite. So it's a debit entry. Now, there's a GST component to this, so we're going to need to create a GST clearing account. When we collect GST, that increases our liability to the tax office, the ATO, but this time we're paying GST. So this offsets or reduces our GST liability. So it's going to decrease. An increase in liability is a credit entry. A decrease is the opposite. So therefore we do a debit entry. Now, I just want to talk a bit about Newton's third law of motion. Every action has an equal and opposite reaction. So in terms of this one here, how do we fund the rent/GST? The word paid is key here. It's going to impact our bank account. So we create a cash at bank. Cash at bank is an asset. It's a resource, an economic resource that provides a future economic benefit. And in this case, it's decreasing because of that payment. So when we decrease an asset, because assets are listed on the debit side of the balance sheet, we're doing the opposite here. So we're going to need a credit. So in terms of Newton's third law here, those two debits in dollar terms are going to equal that one credit in dollars terms. Okay, bought goods for cash. Goods is inventory. Inventory are the goods that we buy with the intention of selling it for a profit. So we're going to create an inventory account. Inventory is an asset. It's a resource, economic resource to provide a future economic benefit when we sell it. We've got more inventory, and so that's going to increase our debit side of our balance sheet, debit entry. Again, there's a GST component, as was the case with the first one. Our liability is going down. It's offsetting what we owe to the ATO, so that will be another debit. And so again, this inventory purchase, along with the GST, is going to reduce our cash at bank. So those two debit entries in dollar terms will equal our one credit in dollar terms. Issued a quote to supply a cafe with 8 board games. That's inventory, including charging GST. This one's an interesting one. Let's just be mindful of what we mean by a transaction. When we have an accounting transaction, it's an exchange between two parties. Now, that exchange could be inventory or it could be cash. There's a few other examples. So in this case, neither. A quote is simply a statement, a promise, an obligation. There's no cash changing hands. There's no inventory changing hands. So in accounting terms, we ignore this. So this is simply a non-transaction. we do need to be mindful that we've made a commitment to sell these goods at a particular price, but that'll come into play when we actually hand over the goods or there's an exchange of cash. So if neither occur, we don't record it anywhere. The next one we get to is sold goods for cash. Again, goods is inventory. Now, this one's an interesting one because when we have a sale, there's both a sale price effect and there's a cost price effect. And we always need to think of this as two separate transactions. So the first thing we're going to do is we're going to create a revenue account, cash sales. Okay, revenue, because it will basically result in an inflow of an economic benefit, increasing assets, and OE, increasing assets in the form of cash. So our revenue is going up. That's going to increase our profit, which will increase the owner's residual claims on the assets. So that will be a credit entry. GST effect again. GST, as we talked about before, is a liability. Now this time we're collecting some GST on behalf of the tax office. So we owe that money. It's not ours. We owe that money to the ATO. So that's increasing our GST liability. When we increase the liability, if we look at our rules, that will be a credit entry as well. Now, where's all this money going to? Well, because it's said selling for cash, that's kind of a bit of a clue that it's going to impact our cash at bank, which is an asset. And this time our bank balance is going up thanks to that money that's going to be deposited in the account. So that will trigger a debit entry. So those two credits in dollar terms will equal that one debit. Now that's dealing with the sale price effect. We've given up some goods, some inventory. So therefore our inventory is actually being decreased because we've handed it over to our customer. And when we decrease an asset, that triggers a credit entry. So what's the opposite effect? Well, if we think about these goods, they did cost us money in terms of the raw materials. So therefore, that sale price effect of that, it's not pure profit. We need to be mindful about the cost price effect. So we create a cost of sales account, which is a trading expense. It'll go under our COGS heading in our income statement. So it's classified as an expense. It is increasing. And so by recording that, that's going to enable us to work out our gross profit in our income statement later. And when we increase an expense, that's a debit entry. So these two will equal each other in dollar terms. The credit to inventory will equal our cost of sales. And one debit at the sale price will equal those two credits at sale price. Okay, we've bought some inventory here, so therefore we need to top up our inventory account, which is an asset going up. So therefore that will be a debit entry, looking at our rules of double entry. There's a GST effect. And so this time, because we have purchased some items on credit, albeit, that's going to decrease or offset our GST liability. So that will also be a debit entry. Now, this transaction was on credit. So there's no money changing hands. We don't touch the bank. So therefore, to acknowledge the twofold effect, we need to create an accounts payable account. Accounts payable is a liability because we're going to make a future sacrifice of an economic resource in the form of cash. And this time it's going up, it's increasing the claims on the assets. So when we increase the liability, if we look at our rules, that's a credit. So those two debits in dollar terms will equal that one credit. Paid for advertising. So therefore we're going to need to create an advertising account. Advertising is an expense because as soon as that advertising campaign is run, it's been consumed. So therefore it results in a reduction in assets in terms of the cash we're going to pay and OE. It satisfies the definitional criteria for an expense. expenses are always going up unless we're doing a correcting entry, so that will be a debit entry. As was the case with that first one we did, the rent, the GST liability is being decreased. We get an offset and we're decreasing our GST payable to the ATO. Bank, EFT, so electronic funds transfer at the point of sale, so therefore our cash at bank has been decreased. So therefore when we decrease our cash at bank, that triggers a credit entry. So those two debits in dollar terms will equal that credit to the bank. Now this one here, issued invoice to customers. When we issue an invoice to customers, and it says at the back end of this, for goods provided, we've provided the goods. So this is a transaction. There's been an exchange, not of money, but of goods. So therefore this transaction needs to be recorded because the customer has bought now, they're going to pay later. Issued invoice, that means it's a credit sale. So we create a revenue account, credit sales, which is revenue going up, which will increase our profit. And so therefore, if we increase our profit, that's going to be a credit entry. There's a GST effect. So this time our GST liability is going up because when we do get those funds, we are going to forward them on to the ATO at the end of a quarter when we do our BAS. So our liability is going up. That's credit. No money changing hands here. We don't touch the bank. So now we're going to need to create an accounts receivable. Accounts receivable is an asset because it is an economic resource and it will trigger a future economic benefit when we receive those funds. So it's an asset going up as a result of the combined effect of that revenue and GST. And when we increase an asset, debit entry. So that one debit equals those two credits. Now, again, as we did back here with this blue one, these two accounts will be affected as well. We've got some inventory going down because we've handed it over to the customer. So that's a decrease in our inventory. There's our credit entry. And there's a cost price impact of this sale that we need to acknowledge so we can accurately record our gross profit. So our expenses are going up and there's our debit. So again, that debit will equal that credit in terms of the cost price effect, and at the sale price, those two credits will equal that debit to accounts receivable in dollar terms. Sent an order form to a supplier for goods required. So therefore, again, this is not a transaction. No goods are changing hands yet. No money is changing hands yet. So therefore, it does not satisfy the criteria for a transaction. So from accounting terms, we don't do anything. Just be mindful of these little traps. Paid accounts payable, an amount owing for inventory purchases. So this goes back to this one here where we've bought some inventory on credit, which created an accounts payable. Now we are settling up with our supplier. So therefore, our accounts payable is being decreased. So our liabilities to them, we're actually reducing it, settling up. And when we decrease a liability, if we look at our rules here, that will be a debit entry. And in terms of the opposite effect of that, every action has an equal and opposite reaction. The money is going to come out of our bank account. So our asset is going to decrease, which will trigger a credit entry. Last one, similar to what we talked about before in principle. This time we're receiving money from that credit sale we had back here. So this time we've got money going into our bank account, which we like. So our asset is going up, which will trigger a debit entry. And we need to acknowledge the opposite effect of this, that our accounts receivable is being decreased. We're swapping one asset for another because our credit customer is reducing their obligation. So therefore that will be a credit entry.